If you are watching silver closely, or even if it has only been sitting quietly on your radar, this moment matters. What just unfolded in the silver market is not another routine rally or short-lived spike. It is a structural shift that has forced traders, institutions, and industrial buyers to reassess what silver really represents in today's global economy. The recent move above the 77 level is not just a technical milestone. It is a signal that deeper forces are converging beneath the surface, and many investors are only beginning to understand the implications. When silver moved decisively above the 77 level and held there, the market sent a message that goes far beyond a simple technical breakout. Price levels like this matter because they represent years of accumulated positioning, expectations, and failed attempts. Resistance zones are created where sellers consistently overwhelm buyers, and when that balance finally breaks, it usually means something fundamental has changed in how participants value the asset. This is why the 77 move is being taken seriously across trading desks rather than dismissed as another short-term spike driven by momentum traders. What makes this breakout especially important is the way it occurred. Silver did not briefly pierce resistance and retreat, which is typical of speculative excess. Instead, it pushed through with sustained volume and followed through with consolidation at higher levels. That behavior suggests broad participation, not just fast money. Institutional players tend to wait for confirmation before committing capital, and holding above a former ceiling is often the signal that risk-reward dynamics have shifted. Once that happens, previous resistance frequently turns into structural support, changing how downside risk is evaluated. From a financial perspective, breakouts of this magnitude often mark the beginning of a repricing phase rather than the end of a move. For years, silver was valued under assumptions of sufficient supply, moderate industrial growth, and limited strategic importance. Those assumptions allowed prices to remain compressed even as demand quietly evolved. When price finally escapes a multi-year range, it forces the market to reassess those embedded beliefs. Models that worked in a low volatility, range-bound environment start to lose relevance, and valuation becomes less anchored to historical averages. Another reason this move cannot be reduced to speculation is timing. Breakouts that occur late in a cycle usually lack follow-through because fundamentals are already priced in. In silver's case, the breakout arrived while physical market signals were tightening, not loosening. That alignment matters. Technical momentum alone rarely sustains a trend unless it is reinforced by real-world constraints. The fact that silver advanced while inventories were already strained suggests the price action is responding to underlying pressure rather than creating it. There is also a psychological dimension that often gets overlooked. Markets are not just pricing assets, they are pricing confidence. When silver remained below 77, it reinforced the belief that upside was limited and that rallies should be sold. Once that level failed, the narrative flipped. Participants who had built strategies around cap prices were forced to adjust, while others who had stayed sidelined began reevaluating exposure. That shift in behavior amplifies the move without relying on hype or emotion-driven buying. Importantly, this does not imply a straight line higher. Structural breakouts often invite volatility as the market searches for a new equilibrium. However, volatility following a confirmed breakout is different from volatility inside a range. In this context, pullbacks serve to test conviction rather than invalidate the trend. The key takeaway for professionals is that silver is no longer trading as a contained, reverting asset. It is being priced in an environment where past ceilings no longer define future potential. And that change in structure is what makes this moment financially significant. One of the most critical forces behind silver's current price behavior is the growing strain in the physical supply chain, a factor that does not always show up clearly on price charts but quietly shapes market reality. Financial markets can trade paper claims on silver endlessly, but physical metal has limits. It must be mined, refined, transported, and stored, and when those processes fall behind demand, pricing dynamics begin to change in subtle but powerful ways. That shift is now becoming visible. For years, the silver market relied on inventories to absorb imbalances between supply and demand. When production lagged, stockpiles filled the gap. That cushion is no longer as deep as it once was. Reports from major storage and trading centers indicate that available inventories are sitting near historically low levels while demand continues to grow. This is not an abstract concern. Physical tightness influences how refiners, manufacturers, and wholesalers behave long before it captures public attention. When sourcing becomes less reliable, buyers stop optimizing for price and start prioritizing availability. This is where silver's financial story becomes more compelling. Unlike many commodities, silver serves both industrial and monetary functions. Industrial users cannot simply pause consumption when prices rise. Production lines depend on consistent inputs. As availability tightens, these participants often secure supply earlier, hold larger working inventories, or accept higher costs to reduce operational risk. That behavior removes metal from circulation and reinforces the scarcity feedback loop, even without speculative buying. From a market mechanics standpoint, physical tightness alters price sensitivity. In a well-supplied market, price increases tend to attract selling, which naturally limits upside. In a constrained market, higher prices do not necessarily release supply at the same rate. Mining output responds slowly, recycling depends on economic incentives and time, and substitution is limited by technical constraints. As a result, price begins to function less as a balancing tool and more as a signal of stress. This environment also exposes a structural vulnerability in paper pricing. Futures markets assume deliverability, but when physical stocks shrink, confidence in that assumption weakens. That does not mean contracts fail, but it does mean participants start to pay closer attention to delivery terms, spreads, and premiums. Small distortions in these areas can carry outsized informational value, signaling pressure that spot prices alone may not immediately reflect. What makes this moment particularly important is that tightness is emerging alongside rising demand rather than during a demand shock. That combination is rare and financially meaningful. It suggests the market is not reacting to a one-off disruption, but adjusting to a sustained imbalance. In such conditions, price movements tend to feel abrupt not because demand suddenly appears, but because supply has quietly disappeared. When the market finally acknowledges that reality, repricing can happen faster than models built on abundance are prepared to handle. Silver's demand profile has undergone a quiet but profound transformation, and that shift is central to understanding why the market is behaving differently today. Historically, silver was viewed primarily through the lens of investment demand, jewelry consumption, and its relationship with gold. Industrial usage existed, but it was often treated as secondary, cyclical, and easily offset by supply. That framework no longer reflects reality. Today, industrial consumption is not just a supporting factor in silver pricing, it is one of the dominant forces shaping market behavior. Nearly half of global silver demand now comes from industrial applications tied to energy infrastructure, electrification, and advanced technology. Solar power is one of the most visible examples. Each new generation of photovoltaic technology relies on silver's unique conductivity and durability, and efficiency improvements have not eliminated the need for the metal. Electric vehicles, power management systems, and high-performance electronics further expand this demand base. These sectors are not driven by short-term economic sentiment alone. They are supported by long-term policy commitments, capital investment, and technological roadmaps that span decades rather than quarters. From a financial standpoint, this changes the elasticity of demand. Investment demand can rise and fall quickly based on price movement, interest rates, or risk sentiment. Industrial demand behaves differently. Manufacturers cannot easily delay production or substitute inputs without incurring costs, redesigning systems, or compromising performance. When silver prices rise, these buyers often continue purchasing because the cost of disruption outweighs the cost of higher input prices. That dynamic reduces the market's natural braking mechanism and allows upward price pressure to persist longer than traditional models anticipate. This shift also alters how silver responds to macroeconomic conditions. In the past, concerns about slowing growth often weighed heavily on industrial metals. Today, many silver-intensive industries are structurally insulated from short-term downturns due to government incentives, energy transition mandates, and infrastructure investment programs. Even in periods of economic uncertainty, demand linked to electrification and renewable energy tends to remain resilient. That resilience adds a layer of stability beneath price action. Even when financial markets appear unsettled, there is also an underappreciated strategic dimension. Silver is increasingly recognized as a critical input rather than a discretionary material. Supply chain planners and procurement teams are not just reacting to spot prices, they are assessing long-term availability. When a material becomes strategically important, behavior changes. Buyers secure longer-term contracts, diversify sourcing, and hold higher inventory buffers. These actions quietly reduce available supply and reinforce the market's tightness without drawing immediate attention. What makes this evolution especially significant is that it redefines silver's identity. The metal is no longer neatly categorized as either precious or industrial. It occupies both roles simultaneously, and that dual function amplifies its sensitivity to multiple economic forces at once. As industrial demand continues to grow alongside investment interest, silver is being pulled in different directions by the same trend. That tension is not speculative, it is structural, and it explains why price behavior today feels unfamiliar compared to previous cycles. One of the most misunderstood aspects of silver's current behavior is the growing divergence between how it is priced financially and how it is experienced physically. On screens, silver appears liquid, continuously traded and efficiently priced through futures contracts, exchange, traded products, and derivatives. In the real economy, however, silver exists as a finite material that must be delivered, refined, and consumed. When these two worlds drift apart, price signals become harder to interpret, and volatility becomes the natural outcome rather than an anomaly. Paper markets are designed to facilitate price discovery, risk transfer, and liquidity. They excel at reflecting expectations, positioning, and short-term shifts in sentiment. Physical markets, by contrast, reflect availability, logistics, and real-world constraints. When supply is ample, these two markets move largely in sync, and price appears stable and predictable. When supply tightens, that synchronization weakens. Financial prices may respond to selling pressure from funds or index rebalancing, while physical buyers continue competing for limited material behind the scenes. This disconnect creates situations where price appears to weaken even as physical conditions remain tight. For observers focused solely on charts, this can look like a loss of momentum or a failed rally. For participants closer to the physical market, it can feel like a mispricing. That difference in perspective explains why narratives around silver often conflict. Both views are partially correct, but they are describing different layers of the same market. From a structural standpoint, futures pricing assumes that delivery is feasible and largely frictionless. When inventories decline and supply chains tighten, that assumption becomes less comfortable. Participants begin paying closer attention to spreads, lease rates, and delivery premiums, which often move before spot prices do. These signals rarely dominate headlines, but they influence institutional behavior quietly and persistently. When enough participants act on them, price adjustments can occur suddenly. Another important factor is time horizon. Paper markets are forward-looking but short-term oriented. Positions are adjusted daily, sometimes hourly, based on risk models and portfolio constraints. Physical markets operate on longer cycles. Industrial users plan months or years ahead and respond to signals about future availability rather than daily price fluctuations. When these timeframes collide, the resulting price action can appear erratic even though it is internally consistent. This divergence also affects investor psychology. Retail participants often assume that price reflects reality in real time. When price falls despite strong fundamental narratives, confidence erodes. That erosion can trigger selling that reinforces paper-driven moves, widening the gap further. Meanwhile, physical buyers may quietly take advantage of lower prices to secure supply, reducing availability even more. The market then carries unresolved tension forward. What makes this phase particularly challenging is that resolution does not occur smoothly. Paper and physical markets rarely reconnect gently once a meaningful gap opens. Reconciliation usually comes through sharp repricing, sudden volatility, or behavioral shifts that catch participants off guard. The confusion many investors feel right now is not a sign of disorder. It is a signal that silver is being priced by two realities at once, and neither can dominate indefinitely. Volatility is often interpreted as a warning sign, but in markets undergoing structural adjustment, it is more accurately described as evidence of transition. Silver's recent price swings are not occurring in a vacuum, nor are they purely the result of speculative excess. They reflect a market attempting to reconcile old pricing frameworks with new supply and demand realities. When an asset moves from being perceived as plentiful to potentially constrained, price behavior rarely remains smooth. In a well-balanced market, where volatility tends to compress because supply responds predictably to price changes, higher prices attract sellers, inventories refill, and equilibrium is restored. Silver is no longer operating under those conditions. Supply responses are slow, capital-intensive, and subject to geological and regulatory limits. Recycling adds incremental flow, but it does not scale rapidly enough to offset structural demand growth. As a result, price fluctuations become sharper because the usual stabilizers are less effective. Institutional mechanics amplify this effect. Many large funds do not trade based on fundamentals in real time. They operate within predefined rules tied to benchmarks, or volatility targets and portfolio weights. When prices move rapidly, these rules can force buying or selling regardless of whether underlying conditions have improved or deteriorated. Index rebalancing, margin adjustments, and risk controls can create bursts of selling even in fundamentally tight markets. These episodes often appear alarming to observers, but they are mechanical rather than reflective of weakening demand. What makes this environment especially confusing is that volatility can coexist with strength. Sharp pullbacks may occur while physical availability remains constrained and industrial demand continues uninterrupted. For participants conditioned to expect smooth trends, this feels contradictory. In reality, it is characteristic of markets where price is trying to find a new reference point. Volatility becomes the mechanism through which conviction is tested and redistributed among participants. There is also an important informational role that volatility plays. Sudden price movements force reassessment. They challenge complacency, expose leverage, and reveal which participants are sensitive to price versus those sensitive to supply. In silver's case, these movements help distinguish between short-term positioning and longer-term strategic demand. Over time, that differentiation contributes to more durable pricing, even if the path there is uncomfortable. Another layer often overlooked is behavioral. Volatility attracts attention, and attention alters participation. New entrants arrive, risk managers tighten controls, and narratives shift rapidly. This churn can exaggerate price swings in both directions, but it also accelerates the process by which the market digests new information. The discomfort many investors feel during volatile periods is not incidental. It is part of how markets transition from one regime to another. In this context, volatility should not be read as evidence that the underlying story is broken. It is a reflection of unresolved tension between constrained supply, evolving demand, and financial structures built for a different era. Until those elements realign, price will continue to move in ways that feel abrupt and counterintuitive, not because the market lacks direction, but because it is in the process of redefining it. Silver is becoming increasingly difficult for the market to value using traditional commodity frameworks, and that difficulty is itself a signal. For decades, silver pricing relied on relatively stable assumptions. Mining output would respond gradually to price, industrial demand would remain cyclical, and investment interest would ebb and flow alongside broader monetary conditions. Those assumptions allowed analysts to anchor expectations to historical averages and cost curves. Today, those anchors are loosening, and the market is struggling to agree on what silver actually represents. This uncertainty is visible in the unusually wide range of credible forecasts. Some analysts project modest appreciation consistent with inflation and incremental demand growth, while others model scenarios that imply far higher prices under conditions of sustained supply tightness. The divergence is not driven by speculation or sensationalism. It reflects the challenge of pricing an asset that now functions simultaneously as a critical industrial input, a strategic resource, and a monetary, sensitive metal. Each role pulls valuation in a different direction, and conventional models were not designed to handle that overlap. From a financial perspective, this transition changes how risk is assessed. When a commodity is easily sourced and easily substituted, price increases tend to self-correct. Silver no longer fits that profile. Its electrical conductivity, thermal properties, and reliability make it difficult to replace at scale without sacrificing performance or incurring higher costs elsewhere. As a result, demand becomes less price-sensitive, and the downside assumptions embedded in many valuation models weaken. There's also a strategic dimension influencing institutional behavior. Governments, corporations, and supply chain managers increasingly view silver through the lens of security rather than efficiency alone. When materials become strategically important, market participants shift from just in-time procurement to precautionary accumulation. That behavior does not announce itself loudly, but it gradually alters available supply and changes the baseline against which price is judged. Analysts attempting to value silver without accounting for this shift risk underestimating long-term pressure. This environment creates discomfort because it resists simple narratives. Price is no longer just a function of cost of production or investment flows. It is influenced by policy direction, technological adoption, and supply chain resilience. When those forces interact, price discovery becomes unstable before it becomes clear, ranges widen, forecasts become conditional, and language grows more cautious, not because analysts lack insight, but because the system they are observing is changing in real time. What makes this moment compelling is that silver is being pulled out of the category of ordinary commodities and into a space where strategic relevance matters. Markets historically struggle during these transitions because they require new reference points. Until those reference points are established, pricing remains contested. That contest is not noise or confusion. It is the process by which the market determines how much strategic scarcity is truly worth in a world increasingly dependent on silver to function. This is the stage where many investors feel conflicted, excited by the upside, anxious about volatility, or uncertain whether they are early or late. Those emotions are normal in markets undergoing structural change. What is dangerous is false certainty. Anyone claiming to know exactly what comes next is ignoring the complexity now embedded in this market. Silver has entered a phase where awareness matters more than comfort. Whether prices consolidate, correct, or accelerate, the underlying story is no longer simple. And in financial markets, the most powerful moves are born not from consensus, but from moments when reality forces a narrative rewrite.